I can't believe the Fed is going to do this. I'm your host, Steven Van Metre, and thanks for joining me today. And Fed Chair Powell warned investors that a major support of the markets is going away, and most investors completely missed it. Let me show you what he was talking about. The American economy is very strong and well positioned to handle tighter monetary policy, Powell said yesterday in his press conference at the Federal Open Market Committee meeting. I saw a committee that is acutely aware of the need to return the economy to price stability, suggesting he's getting serious about bringing inflation down. The hike is likely the first of several to come this year, as the Fed said it anticipates that ongoing increases in the target range will be appropriate, and he repeated his pledge to be nimble. And the key part here is he's saying, I'm going to start fighting inflation, and I'm going to do it at any cost, which means there's going to be a lot more rate hikes coming as long as those numbers stay high. And what this means for investors, well, let me show you. Because when the Fed, when we see here the federal funds rate in blue rises rapidly, it starts to put a ceiling on equity prices and bring volatility back, as we saw in the early 2000s. Now, perhaps coincidentally, it also brought along a recession. But look what happened in the great financial crisis. Now, the Fed ramped up rates really high and really quickly, and eventually the stock market stumbled and entered a recession. And what happened again in 2016, a series of rapid rate hikes and balance sheet unwinding led to a very volatile market and nearly a recession if we didn't have the pandemic. And as you can see now, in the past, the market has usually been rising when the Fed starts hiking, not rolling over and showing signs of a top, signaling that perhaps things are about to get much worse for investors. The Fed faces the arduous task of securing a soft landing for the world's largest economy, a very rare outcome, according to Bloomberg. Tighten too slowly and it risks allowing inflation to run out of control and requiring even tougher action, and shift too quickly, and the central bank could roil markets and tip the economy into a recession. And that's where we start to see what the Fed is about to do, is they're pulling their support from out from underneath the markets. Now, you've heard of what's referred to as the Fed put, or the level that if the market falls to, they will come back and rescue it. And I want you to understand that the Fed put is likely going away. And while history suggests it won't last, an emotion approaching euphoria descended on equity markets on Wednesday and Thursday after Federal Reserve Chair Jerome Powell persuaded investors his first interest rate hikes in 4 years won't throttle the economy. And it's not unusual for stocks to rally in the early stages of a tightening cycle, as I'll show you momentarily. Among 5 Federal Open Market Committee meetings since 1990, when an initial rate hike was announced, 4 saw gains in the S&P 500. Often it was pronouncements about the economy's health that spurred the advancements. And here you can see that this is what investors are betting on, is that the Fed rate hike cycle will see years of equity gains. And as a result, they're eager to get in. But what I want to suggest to you again is the Fed put is gone. And what I'm about to show you is the probabilities of the Fed driving the economy into recession through this hiking cycle, which we should understand is a combination of a withdrawal of fiscal stimulus, withdrawal of monetary stimulus, and an increase in tightening all at the same time, is likely to lead the economy into a recession, because we've never seen this much policy withdrawal at one time ever before in history. And if you're concerned at all about how your portfolio might behave during the next recession that the Fed's about to trigger, well, you shouldn't be. Be sure to check out Portfolio Shield. It was designed to reduce risk during recessions. I'll put a link in the corner and the description below, because now I want to show you just how likely it is we're going to enter a recession, because we're much closer than you might actually think. Echoing our earlier thoughts on this piece from Zero Hedge, that the Fed officially started the countdown to the next recession and rate cuts when it inverted the 5-10 curve. And that the 5-10, if you're wondering, is a 10-year treasury yield subtracting the 5-year. And when it goes negative, when the 10-year is actually lower than 5, it's a major signal of recession. And that happened briefly yesterday. Moments after Powell started speaking, Jim Reed writes that while not every Fed hiking cycle leads to a recession, which is correct, they eventually all do, and that all hiking cycles that invert the curve had led to recessions within 1 to 3 years. And the problem the Fed rate hike cycle starts today, he added, is there is a decent likelihood the curve inverts relatively early on. The 210s peaked in March and traded lower last week. So let's take a look at the 210s, and this is the 10 subtracting the 2-year Treasury yield. And I want you to see that when it is negative, when it inverts, it's below this black line here where it says 0, that signals that a recession is coming. And you see it happen here in 1980, 1982, 1990, that was in late 80s, and a couple of years before the recession. You see here the dot-com bubble was preceded by an inversion. You see the great financial crisis was preceded by one. There would have been a likely recession had the pandemic not happened and a bunch of fiscal stimulus came in. And then again, here we are headed lower on the 210s, signaling that perhaps at the rate we're going, that a recession may not be far off. But yesterday, as Reed noted, that the 510s briefly inverted, and they too are a strong sign of a recession. Let's check out the 510s, which is a 10-year minus the 5-year, and I want you to notice how much better it is at signaling recession. You're going all the way back to 1970. We see in about 74, 1980, 82. Here you see again dot-com bubble, or not dot-com bubble, the late 80s going into the recession in the early 90s. The dot-com bubble, the great financial crisis, the recession we didn't have because of the pandemic, but now we're very close to this inverting again. And when it gets down there, well, that tells you that a recession is happening. And what Powell is trying to tell you is, I've got to deal with inflation. I'm not going to bail out the markets, because he knows, and we can go back to Alan Greenspan, who understood the wealth effect. And we do know that Powell has studied, of course, prior Fed chairs, and he knew, and Greenspan knew, that if equity prices rise, people will spend more. So if you bring equity prices down, well, demand will go away. And that's what Powell's trying to warn you, is his support for the market is gone. And piling on, the CPI is much higher today than it would be in any of those instances, adding even more risk to a recession, and indeed the second highest at the start of any post-war hiking cycle. Thus, according to Reed, there's not only a strong risk that the curve inverts relatively early, but the Fed will need to continue hiking anyways, as I just suggested. A few days ago, we phrased it differently. The Fed wants to push the economy into a modest recession. The only problem is the Fed has never been able to achieve such a delicate balancing act. But there is some good news for the Fed on their side. We can see initial claims for unemployment remain relatively low at 214,000, which is showing strength in the labor market. Even continuing claims are only up 60,000 and still remain below 2 million, which again is nothing but signs of a strong labor market, giving the Fed the green light to continue to hike and putting investors on notice that when the market goes down, should it go down again, that the Fed's not going to bail them out. I'm your host, Steven Van Metre. Thanks for watching. Thanks for being fans. We'll see you soon. Bye now. The content of this video is provides educational information only. It's not intended to provide investment or other advice. This video is not to be construed as recognition or solicitation by any security, financial instrument, or participate in a particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity, opinions expressed in this video that do not affect the value from Financial Advising or Steven Van Metre Financial.